Australia has created a special crypto police unit to combat cash laundering. The move comes after the Australian Transaction Reviews and Evaluation Centre, AUSTRAC, warned earlier this year that cryptocurrencies are increasingly attractive to criminals. The deputy head of AUSTRAC's government division noted that the asset class is also popular with neo-Nazi groups. Australia is among the countries that have introduced strict regulations to combat the problem of money laundering and terrorism financing. The country is currently introducing new laws to combat the issue. For example, initial coin offerings are classified as a restricted business activity. Furthermore, cryptocurrency exchanges must register with the AUSTRAC. Australia's regulations have been designed to protect investors and ensure that cryptos are safe and secure. The legislation only imposes regulatory obligations on crypto exchanges, but does not apply to other cryptocurrencies. The Financial Services Authority will regulate these entities based on the money laundering rules. While it's still early days for cryptocurrency, money laundering activity has become a major route for money laundering. A recent report estimates that $8.6 billion of cryptocurrency will be traded in 2020, rising to $10.9 billion in 2019. The government also wants to ensure that these digital assets are not used to launder illicit funds. Australia's crypto police have been able to seize more than $600 million in unlawful earnings. However, only a fraction of that total was actually cryptocurrency. This was due to the fact that the AFP exceeded their goal of seizing $600 million in proceeds by 2 years. Nevertheless, the Australian government's new anti-money laundering law isn't just about cryptocurrencies. The new bill increases the powers of law enforcement officers, specifically at the borders. Despite a recent review that said that the risks of money laundering at large retailers and ATMs were low, the government's new law will deregulate the physical transfer of money via credit cards and cash within the country's borders. This will likely mean more money laundering investigations. The new regulations will also lead to increased regulation of cryptocurrency exchanges. In the meantime, organized crime groups are increasingly turning to cryptocurrency exchanges for their illegal activities. According to the European Funds Recovery Initiative, in 2017 alone, more than 220 people filed complaints. Of those, 2/3 of the victims had lost money on Binance. Other cryptocurrency exchanges are being used as a means of laundering gains. Money laundering activity is a serious problem for the financial industry in general, but cryptocurrency exchanges can be a hub for illegal activities. According to the World Bank, a single crypto exchange can be used to hide over $8.6 billion in money laundering. This is a problem if the money is derived from illegal activities in a different country. Furthermore, a number of crypto exchanges are prone to hacking and fraud. Australia's new licensing framework for cryptocurrency exchanges will require businesses to register with AUSTRAC and implement a money laundering and counter-terrorism framework. It will also require them to identify their customers and report suspicious transactions. Currently, Australia has several regulators responsible for overseeing the cryptocurrency industry, but the new framework could be a welcome change. A recent report published in the Australian Financial Review highlights that cryptocurrency exchanges are a growing source of money laundering. Despite this, the Reserve Bank of India has banned its regulated financial institutions from dealing with virtual currencies. This regulation prevented companies from trading cryptocurrencies on domestic exchanges and forced existing exchanges to close their doors. However, a Supreme Court ruling in 2020 ruled the RBI's ban as unconstitutional. Malta has a strong regulatory framework for cryptocurrency exchanges, and the government introduced landmark legislation in 2018 to address AML/CFT concerns. The Virtual Financial Assets Act and the Innovative Technology Arrangements and Services Act set the global precedent by introducing an exchange regulatory framework. Australia's regulatory framework for cryptocurrency exchanges follows the same guidelines that are applied to financial institutions. Businesses must obtain 2 licenses from the Financial Intelligence Unit before they can trade cryptocurrencies. This licensing framework is intended to help cryptocurrency exchanges comply with the existing financial legislation. In addition to the licensing framework, Australia is also looking at other ways to prevent money laundering and terrorist financing. Part 3 of the framework addresses the misuse of cryptocurrencies, the obligations of certain entities and the department's ongoing strategies to address these threats. A major crackdown on cryptocurrency money laundering was undertaken in October by law enforcement agencies in Europe, the United States and Australia. In total, 33 people were arrested, including 20 members of the notorious Coutts criminal group. This group allegedly laundered tens of millions of dollars in cryptocurrency for the benefit of cybercriminals and corrupt public officials. The money was transferred through shell companies, international bank accounts, and cryptocurrency mixing services. The authorities also searched 40 homes in Europe and seized Bitcoin mining equipment. While money laundering is as old as currency, the use of cryptocurrencies by criminals is becoming more sophisticated. To combat this, law enforcement must use blockchain analytics and cryptocurrency tracing services. The goal is to trace the money back to its source. In the case of the New Zealand man, following the money has already led to a prosecution case. Former CEO of Bitcoin escrow service Volantis, John Barry Thompson, pleaded guilty to misrepresenting his company's Bitcoin custody and risk exposure. He faces a maximum of 60 years in prison. Cryptocurrency is a popular investment vehicle, but it has also become a target for criminal activity. Criminals use cryptocurrency to hide their identities and launder proceeds from their crimes. The Department of Justice has observed that criminals often use chain hopping to obfuscate the trails of their transactions by shifting from one blockchain to the next. Virtual currency systems present unique legal and regulatory challenges. Because virtual currency systems are global in nature, criminals can use them to transfer funds without a middleman. Because of these differences, law enforcement officers must consider the risk of investigating these transactions. The speed of transactions makes it difficult to pursue cases. A legal framework is necessary to address these challenges. This framework sets forth the responsibilities of different government agencies, as well as a framework for addressing various aspects of cryptocurrency enforcement. The framework discusses how cryptocurrency exchanges, platforms, and kiosks can facilitate criminal activity. It also describes the ongoing strategies of the department to address threats. The report also includes recommendations on how the US should strengthen its cryptocurrency laws and cooperate with foreign law enforcement. In the report, the DOJ highlighted a number of recommendations that include expanding operational efforts with international partners, sharing information with international law enforcement, and closing regulatory gaps between jurisdictions. These recommendations were developed in consultation with the U.S. Department of State, the Department of Treasury, the Department of Homeland Security, and the U.S. Securities and Exchange Commission. International cooperation is essential for the successful implementation of technology-driven financial innovation. This is vital to ensure high standards of transparency, privacy, and security. However, this cooperation also requires continued scrutiny of illicit activities and pursuing opportunities to mitigate these risks.